So this is the S&P,
Yeah, SPY.
the trend line. This. And which, okay, let me just do trend. So I want to do. Oh.
Yeah. Go try doing it on the
How do I move it? We have to go to
move the trend line. Yeah, you have to change it
to the this. Oh. Have to move it.
Yeah, and grab it from the back. Yeah. And then you can just hit cancel. I think you can change the color of the trend line and stuff if you like.
Yeah, so how do I, like this?
Yeah, right there. Change the color.
Make it brighter.
Yeah.
Oh, still not bright. You make it bigger. Okay, so this is what people were talking about, right?
Mhm.
Like we don't know, like now it's going down, but if it hits this line, like if it come down here,
Mhm.
that means it might still go down.
Yeah, so like, yeah, breakdown is possible.
Yes,
Right
yes,
here, and usually like this right here, since it's going up, it's more likely actually, in my opinion, that it breaks down. So you see, for example, like you can do it from here, for example, it's going down,
yeah,
it broke to the upside.
yeah.
It's the same way with this one, you know, but like it's more likely that it breaks down because it's
So if
going
it,
up.
yeah, if it go down under here,
Yeah, it's
it
most,
might start to go down to reach the,
yeah,
this here.
it makes a pretty nice move, yeah.
So what if it's between here, right? So I was thinking, can I just get a long a short, I mean, long a call and then long a put? And then,
Oh,
and then,
so longer call and longer put, so straddle basically to do right here.
yeah, so when it's like here, when it go up, when it go up,
Oh, so you mean when just we have volatility, so going up, down,
and
that's what
then
you mean, right?
profit from there.
Right, yeah, okay, so the move, right, so the move of SPY would have to be large enough that your contracts do, whichever leg does 200%. I'm sorry,
But if I
I'm
get,
sorry, all it has to do 100%, because then you're break even, and anything above 100% is profit. So let's say you make 140% on one leg, that means your profit is 40%,
yeah,
because the other contract lost all its value.
no, but I won't execute it, I mean, it will go up and then it will come down. It's like, if that's here, like
Oh,
in
okay,
between
I see
here,
what you mean, so you're gonna. So
profit both sides,
okay, so you're gonna buy a call and buy a put, right?
yes,
And so let's say you bought it here,
yeah,
you're gonna sell the call here, and then you're gonna sell the put here. That's
yes,
what you mean, right?
yes,
Yeah, you can definitely do that, but you also have to be very careful that, you know, the move, you'd have to play it almost perfectly, you know? Like no emotions, no, I think this, I think
no,
this.
but if, what if I get a longer term, like, you know, 3
Mhm.
months or 6 months?
Over 6 months.
Because 3 months, like 2 months later, we will know, like after 1 month, we will know about the inflation rate,
Mhm.
right? And with the
Correct.
job market, if the inflation rate still stays the same, then Fed might change something, so the market would like go,
Right.
you know,
You know what's tough? You know what's the tough part about that is, like I mentioned last time,
Yeah.
implied volatility. Implied volatility is usually put into these contracts when some sort of news is coming up. So they'll usually be pumped up more than they're actually worth.
mhm,
And so the move won't be sufficient enough to really offset the side.
oh,
Like I'm going to give you an example for Chegg. Okay, so their earnings. How do I?
Go to the,
Actually, on demand, I think, wasn't on demand go? Yeah, on demand.
what do you mean on demand?
On demand, you can go back in the past and trade based on that. Actually, no, that's fine.
Oh, because this is paper,
Yeah. So we can go February 17th, for example.
yeah,
We're gonna take the $25 call. Okay. Sure.
oh, how did you do that? Huh,
Oh, to see the options price?
yeah, okay, so
You
you
can see the
copy-
options price in history, yeah. I'll show
Okay.
you right now. Let me check this first.
So see, it's like 0.01.
What is this? After hours? This is after hours. Okay, so we have this one. I always do that a lot. So I'm going to show you an example what implied volatility does. So we'll just have it to my other trade. All right, let's hope that this wasn't.
We put the, yeah,
This is really good. Okay, anyway, we're going to. Okay, so this, on this day, right here, you see this candle,
yeah,
these gray, by the way, they
the
represent,
volume,
this right here, you know,
Yeah.
it's gray, black,
yeah,
gray represent after hours.
okay,
Yeah, for the most part, I think the first like 30 minutes is still in the day.
but this is 4 hours though,
Yeah, 4 hours.
so we open from 9 to,
Yeah, it's a little weird,
yeah, yeah,
like it's
yeah.
not, all of it is after hours,
Yeah.
it's only just a little, or most of it, but a little bit
Okay.
is, anyways. So you see how the contracts the day before, so this is the day, see how the contracts go from 0.30, let's just say 0.35,
Yeah,
all the way to 60?
yeah,
Okay, now, if I were able to show you the calls did the same exact thing. They went from 0.35 to 60 with no move, the stock wasn't doing anything. But it was because earnings was on this day, these contracts got pumped with volatility because of the expected move. So sometimes you'll be able to see these options that have not been pumped with IV yet, and then you can do the straddle. So you'll make money just by sitting doing nothing and the stock doing nothing. Because it's being pumped with implied
so
volatility.
if I do it here, I will be able to benefit,
Yeah,
yeah,
so let's
so,
say, for example, let me see what earnings we have, for example, tomorrow, or. This also takes time in terms of like, you have to go and look at the options chain and look at historical data and you're
Uh-huh.
like, oh yeah, there's no implied volatility as there should be. Then you could be able to tell, oh yeah, because Chegg, if you look at Chegg, their earnings has humongous moves. So you should be able to know, oh yeah, this is definitely gonna make a big move and these options are undervalued. So I'm gonna play a straddle. But I don't know if you have Earnings Whisper. It's Twitter. It's like an account that announces every week what earnings.
oh, no,
Yeah,
I just go to the calendar,
you
Of
can do it.
the- yeah.
See, you post like See how they post,
Oh, I like that.
yeah, after hours, before, they'll tell you what the average implied move is, so. What's today, Tuesday? So let's do Robin, tomorrow's Robin.
Ooh.
Okay, so that's 10:36.
Oh, I forgot to check. I remember.
Okay, oh wow, so their calls actually. What I'm looking at right now, it's at 10:30, this is next week expiration. Their earnings is tomorrow after hours. If you look at the past historical data of their earnings, I have not looked at it yet, we can do that right now, actually. Okay, so you see, some of the data to make this easier. Okay, so this, they had earnings here. So you see that it wasn't really a big move at all.
Mm-hmm.
Okay, so that's one. I just sort of, anyways, here, this was a pretty nice move. You see, there's nothing crazy, like there really isn't much movement here on the earnings day. And you can see that next week's calls is 0.65, 0.64
Yeah.
for at the money, basically, almost at the money. So 10.5, you see it?
So now it's 10.355, right?
Yeah, that's the current price.
So it means.
So what you would do, if you believe that the options have no implied volatility as they should, you buy this one, then you buy this one. Right, so the first one out of the money for the puts, the first one out of the money for the call. And you can also do it based on price, like you could look 164, then you can look. You should do this one, right? So let's say you buy both of those two, and then you can wait today and all of tomorrow, right before the market closes, and those calls will actually probably be worth more. But you'll make money. And actually, I actually want to do this. Like, let's write down the price right now, so we can like look for tomorrow, see what our.
Oh, no, actually, let's just do it now,
Oh, yeah, paper trade.
because it's paper trade.
So we can see if they indeed did go up and,
Buy,
you go here, it's automatically 10, so we can just do 10, it doesn't really matter, it's
Yeah.
paper, so.
and reach. $200,000. And then there, okay.
So we're getting a 10.5, 0.65 is the price,
Confirm.
should be $650, yep.
Okay, so how do we make money? Do we make money by the price? Bid and ask price? Right, because when it's in the money, the price will go up.
So, yes, like,
Okay.
that's just normally how it works, but right
Yeah.
now what we're playing is only the IV. So we're not playing where it goes, we're not playing, we are just playing the, essentially expecting that these contracts will be put more IV into them.
Let's do one put.
Yeah, I did,
You do both, you do both?
yeah, well, I don't think they filled yet. You know, what I realized with paper trading is that it's harder for it to fill.
Oh, because not many people are in there.
Yeah, or it's just, you know, since paper trading, it's not real, it might take longer, so usually it's like 15 minutes, and then it will fill.
So when we do this, is it,
This is a
Like-
straddle.
yeah, but I mean, if I use the real money, they just take out the money, right? So
Yeah,
if,
so you would
if I
pay-
lose money, then it won't cost me more.
No.
Whatever, okay,
So, you paid 0.65 for the call,
yeah, 650.
and then we point 52, I think it was, but now it's down, so let's just pay 0.52 for the put. So you just add these two,
Eleven.
both of them, then you, what is this,
1170,
so 117 is how much you paid, that's how much you would lose, 117.
but we bought 10, so it's 1170.
Right, so yeah, you would, yeah. But you're right.
But how come I see it was $200,000, now it's less. Remember I had $200,000 and now it's like 100,
Yeah, you do.
11,
You see how our books got filled, but our calls didn't? Yeah, so it still has not filled for whatever reason.
yeah, so this one is filled.
This one, we paid, not sure what, so we got filled at 0.49, is that what we got filled at? Yeah, we got filled at 0.40, no, 0.47 trade price right here. So we're up $20 on that since we have 10, but this one has not been filled. But essentially all we're hoping for is, let's say by tomorrow, right before closes end, this is what we want right here. We're gonna want, let's say the stock stays exactly the same. We want something that goes like this. Right, we just want the value,
Would it be possible? Is it
yeah,
call or put?
both of them, oh, my bad, I'm sorry. But, so both of them would increase in value just based off
How
of,
come?
just based off the premium, by volatility. It's essentially the market makers, the people buying, because we have earnings, so we're expecting to move. You know,
So
sometimes
even if the earning report is bad,
bad,
it will still move.
yes, well, the thing is, we don't even want to hold to the earnings. We just want to hold, because from now till tomorrow, we're just hoping that those calls get pumped.
Yeah.
With volatility.
Okay.
And then just right before the market is about to close, we sell them, and then we collect the premium. You know? And then whatever the percentage is on that money. So what is this? So you have $750 plus, what is that, 13? I think that's correct. Right? I think that's correct.
Oh, Avia went to wrestling practice.
She wrestles,
Yeah, it's a wrestling team.
but as you see, that's your profit essentially.
Let's hope.
This is just a test, you
But
know?
this is,
But you can see on check.
it already went up, right?
Yeah, so you can see this is the 10.50 is 0.68,
So we only make 3 cents.
0.68 on that one, and this one is 0.48.
So this one
But our
is
trade,
money.
but our trade price is 0.47. I don't know how we got at 0.47, but we did. That's why it's paper trading, it's very hard,
Yeah.
but you can see that,
We make money on phone.
yeah, like hypothetically, if you got a 0.47, so let's just say this, we got
Oh,
0.47.
wait. This one is put,
Yeah,
but, we are buying put.
yeah, we're buying put. We're not selling anything.
Okay.
Yeah, selling gives us a lot of risk. And that one is like a whole different, but you can see, right, you made 1 cent on this one. Then you made 3 cents on this one. You know, and just for nothing, right? That's essentially what we're playing at. When we're expecting implied volatility to increase.
Yeah, so that's what I was thinking. For the next few weeks.
Oh yeah, you can do that with
Fine.
like I know my friend that trades SPX. Every FOMC does that, but not for SPY, he does it for SPX. Because SPX gets more implied volatility pumped into it. So he makes 20-30% just holding those contracts.
Yeah, I do
And
SPX too,
Yeah,
because it's cheaper
it's
too.
it's also, they move better, the
It's
contract.
3 times, right?
Yeah.
Yeah, 3 times.
Well, SPX is also 4,000, like, it's 4,150 right now. So it's a much bigger.
Oh, SPX, I do SPXS
Yeah, SPX right here.
and then SPXL,
That's SPX. It's basically, it's
the
just,
same.
yeah, it just trades.
Okay, I do SPXS and SPXL. So it's 3 times of SPX. And long and short. This is short.
Oh, wow.
So I
Isn't
do
it, yeah, is this just inverse or not inverse? I'm sorry.
inverse, like opposite,
Oh, it is opposite.
but this is 3 times.
So it's opposite 3 times.
This is the short of SPX.
3 times.
Yes.
Right, I know this one. Right, I know, I look at this one sometimes, but this is just for the volatility.
Hold it.
Yeah, this one right here. Yeah, UBXY, I watched that one too.
I bought 400.
You bought 400 in it? Oh, so you really are expecting the market to crash, huh?
Yes. I believe
You're a
that.
bear, huh? But yeah, this one I've been watching, this one too. This one's also a nice one that I watch. This one's more stable. It's not really,
Yeah, but they say you have to watch this too.
Yeah.
Because the UVXY is the
It's-
3 times of this, right?
yeah, it's very, it's like leveraged something else. It's, if you look at the chart, it's like. It goes like this. This is the chart of UVXY. It's literally like,
Yeah,
because
it's being,
it decreases in value. And then it has to keep reverse splitting.
yeah.
So yeah. So I watched this one. What else? What else can I talk about? Oh yeah,
Oh, you know what I did? I bought BOIL.
OIL. This one's also probably inverse, right?
This is the, no, this is like, the natural gas. And
Ah.
I bought this because I used to own, KOLD. I own KOLD, but
I know D-gas was used to be a big one, but they delisted it. I guess something happened crazy with it, like squeeze, they went crazy,
yeah,
and then delisted
so
it.
look at
So this is,
KOLD,
so this is, you're basically bullish on natural gas.
bullish, yes.
Yeah.
Because I
which I
have-
agree with you about it.
KOLD.
That's, I actually think that. This is when, is this when gas was ripping higher? When was this? Yeah, this is when gas was literally like at $5, right?
Yeah.
Even more in some states.
So-
So KOLD?
Yeah. So I bought it at like $10, but I sold it at 15.
Hey, I mean,
But
this,
then,
yeah, look
but-
at it, yeah. It's 50%, I mean, it's 50%, it's still 50%.
so I got mad, so
And this is the same thing, right? Natural gas?
this is the opposite. This is
Opposite.
Opposite of
Okay.
BOLD. Yeah,
Ah,
yeah, so that's why I was like, I'm going the other way.
okay, so you do technically, you do leverage just in terms of different ways, like. That's why I said options, you probably might like options, but if you like,
Yeah, but this is already like, to me, I feel like
This
it's
is a-
enough.
right, you know?
Yeah, you know, like I have SPXS
Mm-hmm.
and SPXL. SQQQ, TQQQ. You know,
Right, and those already have a lot of volatility.
yeah, it's
right?
already 3
Yeah.
times.
Depending on your position size, that's already probably a good amount of movement. every day.
Yeah.
You see.
Besides, I don't need to, like this, still like at this moment too complicated.
Yeah, yeah, and like I said, like when I first got into it, it seemed like so much, it took me a while, but like, after you do so much, it just
Yeah,
becomes
then-
like anything else, yeah.
Okay, yeah, my brother, so I call him, I say, hey, I have an idea. Why, can I get a put and a call when this is moving like
Mhm.
here, like because people think it will be, S&P will be running between 39 to 4100.
Right,
So I say, can I just do that? And then he said something like, he said, you should short a call and short a put.
short
But I
call,
didn't get it yet. He said he's busy, so he said he'll tell me tonight.
he said short a call, so sell a call and sell a put.
Yeah, he said that's how you should do it. I don't understand that.
No, I understand what he's saying. He's basically saying you just want to collect premium because you know it's going sideways.
Yeah,
So,
yeah.
for example,
Oh,
yeah, I gotta keep, I don't know why I'm thinking this is but anyways, so let's say this is 41 on the SPY. You said 39, right?
yeah,
So he's basically saying he's gonna be here. He's saying sell a call. Sell a call here, sell a put here. You collect the premium for selling those two. Right? And no matter what the market does here,
mhm,
you collect all that money.
yeah,
That's basically what he's saying. Now, the only risk is your losses, if the SPY goes higher. So say it breaks up like this, it's theoretically your losses are,
But I have put. I can, because I'm short in the put, so when it go higher, I can buy the.
yeah, I
put.
know what you mean. Hold on, let me see. You know what's the best way to do this? See, me personally, I've never, does your brother work in the industry or does he just does it on the side? Really?
It's a financial control. The key, yeah,
If he told you to do that, then I'm sure he's told you for a reason.
Yeah, but
So let's go.
Yeah.
He's very fast, very fast.
yeah, like, we will, like, I don't, oh, I didn't tell you, but we'll go, like, when we go to casino, and then he would immediately calculate what's the odds. And
Oh, really? Counts cards and things like that?
not count cards, but like how to bet to give you better chance to win.
Okay,
Yeah,
so yeah, he's just very smart.
good with numbers.
Okay, so I just did it on Friday. Okay. So yes, your losses are still hypothetically unlimited, like let's say for, God forbid, okay, you're in this position, we're up with the market.
Oh, here. You put it,
Oh, right here.
yeah,
So let's say hypothetically, SPY goes to 1,000, okay? This does 100%, something goes crazy. Your losses would be magnified, like,
but I have a call. I short and I can long the call, like I can, no, I can't. If I buy it back, then means I have to pay. So, but I short a put, I can sell it.
yeah, but the issue with that is, sold the put. I'm trying to think, this is, it hurts my head, but Robinhood actually tells you, you see? So let's say you sold at 415. So this is April 21st expiration. So you sold a put,
So did you do the short a put and short
a
a,
call, yep. And you can see that.
so I can only make this much?
Right, so actually, so you get the $1,800 almost instantly.
But if I
But if
go
the
here,
price goes below, your max loss is,
and if it go up,
if it goes higher,
so I just need to set the
yeah, you just need
The-
to set stop losses.
stop losses
Yeah.
and then before.
But you instantly get the $1,800, like that's yours. That's yours, and as long
But
as,
how much do I pay?
well, that's the thing, you only pay when the stock price goes above the strike price that you sold of the call and below the strike price that you sold of the put. So like you said, if you believe that it's going to trade sideways, that's why your brother told you to do that. That's a very smart, yeah.
See,
But like I said, there is still that very risky, you can still like, if God forbid it you go the other direction.
yeah,
Your
so,
losses are,
so now it's like 410, right? So let's say it will be. It would be 39 and 40, 420
420, right,
and 390.
right, so 420 and 390, that's what you're saying.
Yeah,
Right,
because it would like, because now it's still within the range.
right,
To check how much we can
right.
make.
Well, yeah, the other one that I did that I just showed you was 415,
Okay, oh, okay.
So that
Oh,
would
so you
be-
did 415
yeah, that was-
and then 390?
yeah.
Okay, so,
Yeah. So that was $1,800 that you get to keep. That's for 2 months, what are we on right now, February 7th? So that's 2 months of sideways trip.
so how much is the cost?
The cost, that costs you nothing, it doesn't cost you anything, you instantly get, since you're selling. You're selling these, but that's what I'm saying, that the issue is since you don't own 100 shares of SPY. You risk if the price goes below or the price goes above. So you.
But can
so
I
you have-
choose to buy back like before that?
Yes, yes, you can. You could buy back the put. And you could buy back the call before your losses are made worse. Yeah, you could do that. That's why I said you have to make sure that you're managing your position. So let's say the put is literally right touching the edge of your, what's it called? Your position, the 390.
Yeah,
Let's say you're down $400. So this is minus all your 1,800 that you got premium and an extra 400. So you're actually down $400. You can buy back the 390 call
how much would it cost?
and I'm not sure. I'll have to check.
So,
The sooner, by the way, so let's say it goes down instantly and goes
Yeah.
below faster, it's
Yeah.
worse for you. It's worse off. Like you would rather have it do it here because the theta has decayed. It is too complicated. That's why your brother, you gotta tell him that your brother is, he might have to manage this for you because it's also kind of like I said, it's also kind of like risk, it has a lot of risk to it. Like you have, like I said, almost.
no, but you say I get 1,800 instantly,
Instantly, yep.
so. But that's something I haven't paid, right?
You haven't paid anything, yep.
So how do I pay? How do I minimize my cost?
Minimize your cost to buy, you're talking about when you, like, hypothetically have to buy back the call or the put, right?
Yeah.
Well, you don't ever have to pay. I just want to let you know, you don't ever have to pay unless your position, you're scared that your position is going to go the opposite direction of what you think. So,
So if it would be within the range.
yeah, you don't have to do
I just
anything
wait
until they
till it
expire.
expires.
Yep.
You-
That's what, by the way, that's what market makers do. And that's how they kind of manipulate the price. So if I'm a market maker and I sell a bunch of 430 calls, I don't want the price to go above it because then now the market maker is obligated to give all those people that had those calls and they exercised, now they gotta buy all those shares. So that's why market makers, like you'll sometimes hear, oh, they manipulate the price, they do all this.
Yeah,
That's why.
yeah, and my brother told me they have AI
Mhm.
to, they set like the pressure point, so
Mhm.
where they, that's
Yeah.
how they,
Yep.
yeah. So that's why he said you need to watch of
Yeah,
those level, and then if it pass, that means they can't control it anymore.
right. Yeah. Yeah,
Yeah.
that's why I personally, I love algorithm trading, and I think that would bring anybody the best chances of trading consistently. That's the goal, right? Is you just trade consistently. But yeah, so you instantly collect the 1,800. You don't have to buy back anything as long as it's in your range. Now, if at any point that you believe the position is gonna go in the opposite direction, you buy back. You can buy back at a profit too, you know? So you don't have to buy back when you're at a loss. If you get into the middle of the expiration date and you still have like a month left, but SPY is sitting here, but let's say you're tired of it, you don't wanna keep the risk, the exposure, you just buy back, maybe buy back the both of the contracts for $1,000, so you lose 1,000, but since you got $1,800,
So you make
so you make $800.
Oh,
Yeah. Now, like I said, the reason some people don't do this, most people don't do this, like retail investors, is because of the risk. So this goes below. Now have to buy 100 shares at 390. So that's $39,000.
I don't buy, I sell though.
If you get, trying to think. If your puts go underneath, you're going to be, how do I say this? It all depends on the person also, by the way. Like some people like, let's say you sold a person a call, they might not want to exercise it, even though it's,
Yeah.
so it all depends. Well, I can show you right now.
Oh, that's why Robinhood is, it's good, like, I know their app is easy to use.
They can show you, yeah, and I'm sure there's other brokers that do that. They
Yeah,
just
but-
added that, by the way. They didn't have this all the time.
Uh,
I actually didn't even know that till I
But can you do stop loss on Robinhood?
stopped loss. Yes, you can.
Really?
Yeah, I'm pretty sure you can. Let's just do an example, just to put, so you can see. Okay. So,
That is,
yeah, so I'm selling a 410 put. See that?
okay. So that means if it's lower than 410, this is your loss. Right?
No, so,
The red part,
yeah, the red part is this.
yeah, when it's under 410, is it?
Trying to figure out right now. It's interesting. Anyway, you can see, as soon as you hit anywhere here, anywhere in here, you can be exercised, like you have that risk.
Yeah. So I would probably exercise when it's here.
Yeah, or like get out,
Or
yeah,
like here.
yeah, like risk it, yeah, sell it, yeah. But
So
this,
your maximize will be. Your maximum profit is 410 because you bought it at 410.
so
So
well, you're selling it, you're selling it,
selling it at 410.
you're selling it at 1070. So you're collecting $1,070 premium.
Yeah, but you were making the same when the SPY price that's only over 410, you are making the same profit. Right?
Oh, yeah, above 410? Yeah, no, you want it to keep going up.
But you can make more because
Yeah, that's it, that's just the premium,
that's weird though.
because you sold it. So all you collect, when you sell a contract, your risk is essentially that the stock goes against you and goes.
So that's
So
like
that's why buying is much more different than selling.
So you sold is that a call?
This is the put.
You sold a put. That means it's not the same as you buy a call.
No, it's not the same. I mean, you're bullish, so if you buy a call, you're bullish, right? If you sell a put, you're also bullish.
Yeah, so what's the difference?
The difference is when you buy a call, your gains are unlimited, like theoretically
Yeah.
unlimited. But when you sell a put,
It's not there.
your maximum loss, yeah, so your maximum gain is the premium that the person paid you for the call, for the put. And your maximum loss is the strike price that you sold. Because when it goes in
Because
the,
you're short.
yeah, so if it goes in the money, you're like obligated, you're acting as like a market maker, as a seller. You're obligated to, when the person exercises it, to give them 100 shares. Actually, no, I'm sorry, not give them 100 shares, buy 100 shares
Yeah, you are obligated to
buy
buy
100
100
shares.
at
So-
410.
at 410, yeah, for this example. For that example, it's 390.
So how come when it's 420? You don't make money, you should make money when it's 420 though. Like because then,
Oh, you mean like it goes up?
yeah, then the price will be higher,
Yeah, I mean, that's
but it's not predictable there,
yeah,
right?
well,
It's,
you don't make money if it goes higher, yeah. If you sell a put and it goes higher, yeah, you don't make more money, just make the gains. Now, if it goes in the opposite direction,
you lost
where?
there because if it goes
Oh,
down.
in the opposite direction, yeah, you lost, yeah. If it goes below whatever the strike price you sold, then you gotta start thinking that you have a very high, have a good amount of risk that it's
Yeah, you
exercise,
have to sell it,
it's exercise or buyback, yeah.
but if it's,
It-
I would probably sell it, but I don't understand then why would people short a put?
You know,
Because,
it's actually interesting, a lot of people.
because I would probably buy it in between here and, I mean, like, go back
Like sell.
between here and here, when I still have profit.
Right,
But this is the thing I don't understand, because,
so this, everything that we see here is the price by the expiration date,
Yeah,
by the expiration. So not in between. So this all differs. So like I'm gonna show you an example right now. Let's say you got 1,800, right?
yeah.
And then you got the call, you sold the call on the put,
Mhm.
and the price, for example, does this immediately, right?
Yeah.
But it's gonna go down, right?
Mhm.
Over here, your losses, you would probably be losing money over here.
Yeah,
You're gonna be, even though it's not above it, losing money because of how fast it did it. You know, it's very important that it actually really does go sideways.
yeah,
And now, like if you get, let's say, for example, here, towards the expiration here, it just does this, it doesn't matter, because those contracts are going to be worthless. Because the trader just dug in from so close.
yeah, okay, okay. But if it's here, then it.
Yeah, it still has all that time, yeah, there's all that
There's a value.
premium, intrinsic value, all that, yeah. And intrinsic value, well, not yet, because it's out of money, but yeah. But yeah, me personally, that's very risky, I would never do that.
Yeah, because then I don't understand,
Your brother, by the way, probably has a bunch of different data and he probably knows a lot more, like for you to do that. It's the premium that you're collecting is very nice, by the way, it's just you would also, would almost need to be certain that it's going to
no,
happen.
but the premium is limited though.
Yeah, it's limited,
Yeah, so I don't understand why I rather do loss limited and premium unlimited.
yeah, that's why people like doing calls, yeah,
Yeah, so,
but see, but you told your brother that you think it's gonna go sideways. And that's why you profit doing this from it going sideways.
okay,
So your brother said, oh, okay, if you want to do sideways, then that's fine, just you gotta do this.
why can't I just get a, let's say SPXS and
Mhm.
then SPXL?
And then just sell each
Yeah.
one, yeah, you can do that, yeah. Yeah, that's what I'm saying. And oh, by the way, it has much less risk doing that way, like the way that you were doing.
Yeah, but it's a little bit more expensive.
Yeah, of course,
Yeah, yeah. Maybe that's one. Yep. So, yeah, so do you think she said, can we change the time to 3 to 4 on Tuesdays?
I'm fine with that.
Me,
It's all up to you, I don't know what your schedule is like.
well, the Tuesdays, we have meetings from 2 to 4,
2 to 4?
like usually, no class from 2 to 4. No, but Evia says she has the,
Cause she has wrestling?
yeah, from 2 to 3. So, let me double check with her when she's done. Okay, let me stop here.